Hello and welcome back to another episode of Crypto. My God, guys, there's some fun stuff happening inside the industry right now. And in this episode, I want to talk about capitalization and how projects do it. Now, you might be very familiar with meme coins. They capitalize through the simplest method possible. It's called a contract address. You've been maybe seeing it with Vine last night, right? I mean, he just got on Twitter and literally tossed out, remembering all the fun we had building Vine. Let's relive the magic and do it for the Vine coin contract address. So this one's pretty funny. Obviously, there's a little selfie and a proof of liveness. That's what we call this when someone just shows that they're not being a bot. But this is one of the simplest way to capitalize something. Now, in this sense, this is really a meme coin. It's very difficult to say how it integrates with any sort of business, and if it did, it would be violating a variety of securities laws. But capitalizing a product or a project is one of the first things that any developer or founder needs to consider, right? How do I raise money around this? The idea of selling into equity is one of the core foundational elements that crypto really attempted to shift by selling tokens initially, the idea being that the equity in these foundations would dissolve and it would hold no value, and all value would accrue to the token holders. That's the original ethos of crypto, of decentralized capitalization and things of that nature. However, what we ended up finding out over time is that, legally speaking, the equity model does give a lot more rights, many more rights to the people that are placing that investment. So now we're back to sort of a dual equity token model where you own both, and hopefully one really goes to zero while the other has all the value accrual, and you can just say, for taxation purposes, I'm living over there in the value accrual. Now, what's interesting is we are responding to about 2 cycles worth of capitalization issues. The first being 2017, when everyone would launch via the ICOs. These were, again, sort of, hey guys, I have an idea. I wrote it down on a napkin. You want to fund it, and then I'll go and build it. And what we ended up seeing was a ton of scams, a lot of grifts, a lot of people raising money and then putting out the base product and then leaving for retirement. And basically, it proved to be an amazing bootstrapping mechanism, but not necessarily a very good sticky play. The tokens would see a pump, they would see a dump, everybody would lose their excitement and their energy. And of course, it should really be the opposite, right? We should have a product grow, provide value, and show that it has some real legs under it. And then the asset price should rise. So crypto in many ways inverted the standard equity play. Then following 2017, because the ICOs were very much deemed illegal and the regulators had caught on, nobody wanted to do these. So what they did instead was they built these equity packages, these token deals, and they sold them privately, mostly to venture capital. However, what we received were tons of coins valued at billions of dollars that had the majority of the tokens being sold to private owners. That means that there was a lot of sell side pressure, a lot of capacity for people who had bought these things maybe at a very early stage to sell and to dump on the public. Now, the way capitalization works is I go to you and you're my first investor and I say, hey, I'm going to value this company at $5 million. That means the percentage of tokens to every dollar is very large, right? $1 will buy you many tokens. You close that round, you maybe build a little bit. But what people actually do is they go from round to round to round. So you would go from, I'll sell you, 1,000 tokens at a $5 million valuation to now we're worth $50 million. So that's a 10x decrease. I'll sell you 100 tokens for the same amount of money. And then you go from 500, you double that to a billion. And you say, okay, great. Now from the 10,000 or 1,000 tokens I originally sold for $5, I will sell, we went half of that to 500 and then again, doubling down to 250. So you can see how the value per dollar in tokens diminishes as the valuation increases. The venture capital companies and the firms are the ones doing the initial diligence. They do send a signal when they place their money and place their bets saying that we've looked at this. We think it's valid. We think that it has credence and depth, but we did have the opportunity to use $5 to buy 1,000 tokens. And by the time it hits the public market, it might be $5 for 250 tokens or even less. So what occurred was you have these highly valued assets that hit the market. There's no real reason for retail interest to come in and purchase it because they feel that they're really just bearing the weight of sell pressure, right, being the exit liquidity. And that model has also sort of hit ahead where companies are going public at way too high a price. It's just not good for their community. All the people that want to buy this token to support it and ride it upwards, they don't really have that opportunity. Now, that opportunity did exist in ICOs, but then it moved back towards venture crowdfunding. So what we're seeing now is a response to all of that. Everybody that got into the Ethereum ecosystem very early on was a big fan of ICOs. At this point in time, in 2017, they would really just put out, just like a meme coin, a contract address. And if you were able to fund it, they would send you tokens. Of course, this had to be agreed upon with a handshake or a conversation, unlike a meme coin, because there were only a finite amount of tokens, right? They had to make sure that they gave them to everybody. But then the interesting thing happens, which is that we've become inundated with these very expensive VC coins, as we call them. They're launching and they're just starting to drop. So everybody gets a little exhausted about this, and they turn to something that the regulators said is okay, a baseless asset with no real centralized organization or operator behind it that's providing a promise of revenue growth and sort of a return of value. That's where you get into securities laws, is if you give somebody else, a third party, $1 and they tell you, I'm going to turn that into $2. That's where we get into a security. That is what equity is, all of those fun things. So the response was meme coins. And now we have this baseless asset that's just kind of a lulz. It has no real team behind it. It has no promise of returns. And as such, it has no ceiling. That's why investors are now chasing meme coins. Even though they don't mean anything, they don't hold value, it's their opportunity to get in again on those private low valuation rounds. You might go onto Twitter and see people posting like a sub 100 million valuation coin, right? They're looking at those early inception dates. So now we're falling back. Again, the pendulum swings and everybody's looking back and forth. And everyone's pursuing a way, especially following the exit of the Gary Gensler regime, to return back to that ICO mechanism, but to have it be a little bit more robust, right? We don't want to see just like napkin ideas that get their funding. These should be real projects. They should have some sort of signal. The venture capital market is good for that signal. Now, we can see a very interesting take here that just came out on the block, which is why JP Morgan predicts VC funding in 2025 will fall short of the 2021-2022 peaks. This is due to a few reasons. One I just discussed, which is that the VCs are now being viewed as a bit of an antagonist, right? They're consuming too much of the token supply. And when they sell, because they have to return money back to their investors, it's looked at as basically using the public as exit liquidity. So JP Morgan saying, we don't really see the appetite there. And one thing we did kind of get a very aggressive visual from with the Trump coin was, and I spoke about this, you could see the Trump coin going up and being green in a sea of red. There's just not that much liquidity in these markets. So when something goes up, other things are going down. That's not very useful. We would like the overall market liquidity to grow, to onboard new money. That's how a healthy economy works. And one of the key things behind this VC funding falling short is really the advent and the desire to return to this ICO model, to give more people broader access, right? You want to be more inclusive, to spread your token out, to decentralize it, and to share those winnings. Now, what is sort of being landed on as an in-between between the full ICO, which was just open full gates to anybody, is what's called a special purpose vehicle. It's an SPV. You can think of these as mini funds. Somebody, an individual, a team can spin them up. They can go out and they can say, let's use SpaceX, for example. Hey, SpaceX, can I get $1 million of your equity? And they create this SPV, this little mini company fund, and they put that $1 million of equity that they could purchase from SpaceX into it. Then you go around and you shop it to people with money, and you say, hey, do you have $1,000? Do you have 100,000? Like, do you want to get a slice of this $1 million worth of equity? You put it inside the SPV. The SPV basically raises the money, and that's what the business does. It makes the investment. It's a really nice and concise way for a variety of investors to create this coalition and to make a single investment. So an SPV doesn't often include numerous companies. I mean, it can. You can do whatever you want with them, really. But very oftentimes they are spun up for a specific investment that is used to attract attention. Now, what's really interesting about them is the people that spin them up, the people who control them, they do get a little percentage. So it's very useful to basically give one hustler a decent allocation, and they go out and they fill that with a variety of others. It spreads your distribution. It also limits your work. Their benefit is that they get to take a little bit of the percentage of what they've done. So this is the SPV. It's not a new idea. It's something that's really been tried and true in the past. Now, one of the biggest issues with the way the ICOs worked and functioned in the past, basically being open to everyone, is what is called accredited investor laws. These are probably some of the most toxic things that actually exist in the financial ecosystem and are basically a gate to make the rich richer. What it says is that you must be an accredited investor to be able to participate in these private offerings, right? If you want good deals cheap, you need to pass this test. What is the test? The test is really just about how much money you have. If you have $1 million, you're an accredited investor. If you make $200,000 a year, you're an accredited investor. Now, they just recently expanded it to say if you work inside of a financial industry, you can at least get in on accreditation. You're not rich, you're young, but like you understand what you're doing. The idea was to be a gatekeeper for people to not get screwed, right? They didn't want your mom and your pop to get into a deal that they just simply didn't understand. Now, to limit that via off just how much money you have in your bank account, that seems a bit insane to me. And it's a pretty gross approach, right? Meme coins get around a lot of this, but meme coins also don't have value. Now, the accredited investor rules, it's something that I hope to see updated. But for the meantime, what is happening inside of the crypto ecosystem is to say, hey, can we create these SPVs, these special purpose vehicles, around accredited investors? And of course, it is a big update to say that if you work in some place where you understand how investments operate, that you now pass that accreditation. This means you could be in your early 20s and intern at a firm, and at least you'll get access to these deals, right? They're an amazing way to grow wealth. So over the past couple of years, the community inside of crypto has really looked back at the ICO era and said, we want that. We don't want these venture funds to collect all of these early deals, right, to become the biggest whales in all of crypto. This is basically the Silicon Valley model, the traditional model that crypto is built to disrupt. And Kobe, for anyone who follows him, an early Bitcoiner, made a lot of good moves following the Silk Road era, but he's been an evangelist of Bitcoin for a very long time and a well-to-do man who's, basically retirement capable, eligible, I should say. But he turned around and said, no, I want to open up access. I want to build something that others cannot build. So he just recently launched this echo.xyz. A lot of this is following the MiCA law update in Europe, which actually puts around some frameworks for how to invest in crypto and digital assets. But Echo is a really interesting idea. A decentralized economy demands a distributed community. Concentrated VC ownership is anti-pattern inherited from traditional fundraising. Echo helps projects focus on decentralization reach a broader audience of real people from day one. So this is very much in line with what I was discussing. And it's an interesting website if you want to come in here and look at it. Again, do I have to trust an investor with my lead investment? And what Echo is really a marketplace for people that are running SPVs to shop their wares. This is a discoverability platform around special purpose vehicles. So this is pretty cool. It's an in-between. So while it is closed and sort of gated by the accredited investor laws, it is much more open. And outside the US, I will say accreditation is a little bit more easy to facilitate. Inside the US, we really need to look at these rule sets. However, this allows you to go through and you can see what sort of deals people are offering. And of course, this can become a personal finance kind of business for these people. If they can go and source really good deals and bring it to all of their friends inside these groups that then fill it, they get a percentage and they make a living off of this. So it's a really interesting way to bring access to deals and to, again, as a project, raise money in a way that you get your tokens into as many hands as possible. So what we're seeing is a move a little bit away from the density of venture capital capture, not quite as crazy as the ICO era of 2017, but at least products are being built around this. And it's really exciting for me to see because I think this does open access, even if it's not all the way to retail, like mom and pop, the way we envision it, but it's a step in the right direction. And of course, Echo is not the only one. There's also Legion, which came out of a VC firm called Delphi. Delphi does research. They do venture capital. They're really excellent group of humans. I'm a big fan of them, and you can check them out, DELPHI. But they were also sort of in this boat. They made a lot of that wealth that they do through venture via the ICO era, right? Via early crypto projects. And now they're like, we owe it to the community to figure out how we can give back, right? The initial statement investing is broken. Enough investment opportunities locking out the many of us. It's time for equal access, equal opportunities. We stand for collective value creation, not exclusion. So they're doing a very similar vibe. It's another take on it, and it's another one to follow the Mika release out of Europe. So this is all really fun and exciting to see that this is happening. Again, it's very largely caters to non-US, which is stressful, but again, I do hope that we can open that up through further conversations. Now, what we are seeing is, in response to all of this, we have AngelList, which is essentially an SPV platform. AngelList is a way for anyone to create a fund or an SPV vehicle very easily. And they're partnering with Coinlist to do exactly the same thing. Basically, they're letting people make these special purpose vehicles, which you can see right here. And they're calling them crypto roll-up vehicles, which is just a cute name. But it has 0 fees, which is pretty interesting. And through this, investors can fund with USDC, which is easier for crypto investors who don't operate via banks. This is a big point, right? These SPVs allow you to fund it directly through a crypto wallet versus a bank, and debanking has been a problem. So this is just a really easy way for people with access to the project allocations to go raise capital around it to increase the exposure of a company's initial coin offerings to more people, right? We want to decentralize the token holders. It's healthy for a project. So all of this is really fun and exciting to watch. It is an industry maturing, finding out better ways to capitalize the projects that are inside of it, right? We obviously don't want it. It can't be too big and exposed. Otherwise, we get into meme coin territory. ICOs and meme coins, essentially the same thing, right? Just a contract address that anyone throws money into. Maybe it goes to 0, maybe it goes to 1 billion, who knows? But financial regulation is good. There's infinite grifters out there, many people that want to rip you off. It's just that too much of it is overly aggressive. And now the industry is, again, the pendulum continues to swing, and it's finding its nice medium balance. So this is all really, really cool, really interesting. If you want to learn more about them, I'll put all of the websites in the description. And hopefully the industry will grow. We'll see more projects raising valuations that are lower, that are selling to the broad public. And of course, before I sign off, I just want to show an example. It's very exciting to see these things in action. Very recently, Corn, which is a DeFi project built on the Bitcoin network. So it's one of these new and novel ways of trying to use Bitcoin for more interesting things like programmatic money and execution. They just completed their $8.3 million community raise. Now, what's fun, some investors that are listed here on this image, they're actually VC funds, and they had to participate in the same way that's available to anybody else that meets those KYC criteria, know your client. So this is really cool. It had over 675 investors with 4,200 applicants. Over $6.9 million waiting to get in on this 8.3 million. So massive oversubscription. This is a very good signal because, one, this happens in public where people can see it. Crypto is about transparency. And it also sets up their message with this oversubscription that there is still buy-side demand. So if they do launch this coin, if they go public, there's an understanding amongst the market that people are actually still interested in accumulating this, right? Versus seeing these large valuations when they go live, and we're assuming that people just want to sell. So check out Corn. It's just a fun project, and they're one of the most recent to do this, to go through this capitalization process, which is really new, really healthy, and really exciting. As always, this stuff is all kind of mania. I hope to break it down and to add some clarity to how not only the current financial system operates, but what crypto and decentralized asset management wants to facilitate. And, as always, good luck, guys. I mean, hopefully we're moving from a meme coin meta to a more stable investment meta. I personally, while I love the get rich quick schemes, I hate the get rich poor schemes, and I would love to put $1 into something and wake up next year with it being worth $2, $3. So as always, guys, enjoy those markets out there. Good luck to you, and I'll talk to you tomorrow.